Well, it's that time of year where we all get together and we pontificate on what the future looks to bring in 2025. 2024 has obviously been a very strong year. In fact, stronger and more to the outer bounds of what we thought was what was possible. I would say if we're thinking about 2025, a lot of what we're hearing is relatively constrained, and we have somewhat of a conservative base case ourselves for the equity markets, and a more neutral case for fixed income. That being said, I do think that this is a year where we could see the extremes or the tails being much wider, and we'll take some time to discuss that as well. But first, Anne-Marie, do you want to walk through what our bull bear scenario is for 2025?
Absolutely, John. And for 2025, one thing that we've looked at is current expectations for earnings as well as what the market is pricing in. And I know we'll kind of go in through a lot of kind of what goes into that as far as political economy, geopolitical aspects. But for 2025, the outlook that we have is a range. And again, this is the S&P 500. This is only a price only, so it does not include dividends. But we're looking and we're sitting here with the S&P close to 6,000, to a modest increase, closer between 61 and about 6,200 for the S&P. And this is a combination of what's being already priced in as far as forward earnings for 2025, which sits around $272. On the bear case side, as John mentioned, we are increasing the probability of that bear case. Last year, we were about 5 to 15%. This year, we're increasing to 15 to 20%. And some of that will be, a little bit of a transition, potentially as we go into the first quarter of 2025, with a pullback in the magnitude of 10 to 15%. And that translates to about 5,300 on the S&P 500. On the bull case, again, the probability is going up. Last year, we were looking at about 15 to 20%. And for 2025, we're increasing that probability to 20 to 25%. And even as you're going to hear, we've even debated, what that bull case range should be. And quick math, looking at 2025, 2026 earnings and multiples, which stand around about 22.5 to, let's go 23%, and we go above that, you can easily get to about 65, 6,800 on the S&P, but you can almost stretch that to 7,000.
Thank you. Patrick, you've worked in Washington. You've run a big macro hedge fund portfolio. What are some of your thoughts about where some of the risks really lie in this environment going forward? We're all pretty positive about the transition we see taking place politically, but those things are never as smooth as we like to think they are.
Yeah, so thanks, John. I think that the sort of high-level frame for what we're seeing is certainly the plan or the strategy for the Trump administration and the whole kind of movement that he's pushing to make America first, I guess you can call it, is really, you can think of it as a transition away from consumption-based growth and consumption-driven economy. It's still going to be majority consumption. About 70% of GDP in the US is consumption, but a move to balance that more with much more production. Like, one of the metrics you can look at is our very large trade deficits is really a function of us consuming a lot more than we produce. And the entire agenda of tariffs, deregulation, and other just encouraging investment within the US, that's all trying to move the economy in the direction of production rather than consumption. And that's, I think most would agree, that's a very positive development long term for the US for wealth creation and standards of living. But since we do have an economy that's currently very dependent on consumption, there is always going to be the risk of kind of an air pocket where consumption, whether it's because deficit reduction is more aggressive than the economy is able to sustain at that moment, you can get sort of an air pocket in consumption, and a lot of businesses are dependent on that consumption as we transition to what I think is probably overall a much healthier balance in the economy where it's more production oriented. That production requires workers and labor, so their wages would go up, and ultimately that flows back into consumption. But the sort of highly stimulated consumption that comes from deficits, it's almost like the handoff. There's going to be a risk of that. So I would say that is the downside risk for the economy, meaning in the direction of potentially not necessarily a recession, but just a little disappointment. And I think I'll give it back to you, John, because I think Thano has some discussion of kind of in the opposite direction of where some of the risks would come if it runs a little bit too hot.
Sure. Yeah, and I do think those are, very good points because, as much as we can talk about what the baseline is, I think when we build portfolios, we really have to think about what are those tails look like and make sure that we've got portfolios that can capture both the upside yet still protect on the downside. But yes, you're right. As anything you say that comes out of Washington, nothing hits as smoothly as we think. And there's certainly been a lot of pricing in already of pretty rosy scenarios from that standpoint. Thano, you've been a Wall Street sell-side analyst. You've run big equity portfolios, both on the long side and the short side. What are your sort of thoughts in terms of particularly what the upside looks like for equity markets and for equity valuations, and what are the drivers there?
Yeah, thanks, John. I think if we take a look actually at 2025, there's probably not a lot of variability to the actual earnings outlook. Even if the Trump administration gets everything that he wants, it takes a little time for it to trickle through. Where I think you're going to see the opportunity for either the market to fulfill a bear case scenario or a bull case scenario will really be based on multiple contraction or multiple expansion. And, on the positive side, we all know the Trump administration's goals of extending the Trump era tax cuts, possibly adding additional tax cuts for individuals, as well as reducing corporate tax rates. There's a lot of talk about deregulation. It seems like it's easy, but it's never as easy as it sounds. And obviously, there's been particular emphasis from international investors in the cost-cutting story with DOJ. If those things come to pass and the Trump administration threads the needle with this razor-thin majority that they have in the House, the animal spirits, the amount of fixed income investment, any kind of change in the outlook of our fiscal largesse, meaning that deficits don't continue to expand, but actually are held in check and shrink as a percentage of GDP, could really result in a much more bullish outlook for investors and an expansion of multiples that could happen very quickly. But this is going to be down to sort of sequencing, because while all that is positive, there are some things in the short term, such as tariffs, which we really have no idea to what extent they may be imposed and when they may be imposed, as well as a potential for substantial deportation that could bounce some of the inflation data that we're seeing in the short term. Now, if inflation was lower, closer to the goal of the Feds, then I don't think this would be a risk. But the fact of the matter is that inflation has sort of stopped going down for the last 3 or 4 reporting periods. And while we had some help from the shelter in place, other things are starting to poke up. So we've made a lot of progress since 8 to 9%, but we're still nowhere near 2. So that's the sort of risk on the economy side that could be either exacerbated for things that are already in place, or possibly before we get the benefits of some of the things that the Trump administration has been talking about, we get some of the pain earlier. We'll just have to see how that works itself out. It would be a lot easier if the Republicans had maybe a 10-seat majority instead of 3.
Instead of 1.
Well, I guess it's 1 as of today.
Yeah. So thank you very much. I think that really helps lay some of that out. Anne-Marie, can you just quickly go over what our expectation on fixed income is? Because I think this is an important factor that ultimately will impact the equity markets as well.
Absolutely. This is just looking at the 10-year. The range that we have for the base case, and again, the Fed is probably going to cut 25 later today. I know expectations for 2025 rate cuts have kind of moved up a little bit, but we're looking closer to 10-year yields to be kind of range bound, between 4 and 4.25 for next year. Now, on the other side of that, we could see an environment where yields get driven down all the way to closer to 3.25 or so if we were to see some kind of recession and so on, and things get really ugly there. But I think more importantly, and this goes back to the outcomes, treasury yields we've talked about, what would happen if they were to go up given the inflation story, deficits and whatnot, and obviously, how that would go into potentially treasury yields moving above 5%. And we do have that in the scenarios looking for yields to break 5% and be closer to 5.25.
Yeah, I think that's important. And let me just sort of walk through some of this arithmetic of how we sort of get to those ranges. The Fed has a target of 2% on inflation. We're sort of hovering on a historic basis down around trying to get down to 3% right now. I don't think the Fed is going to move off those targets, but I do think that they can easily live with a 2.5% inflation rate. They're going to want it below 3. And then if we think about what the term premium means, which, the premium in order to go farther out on the yield curve, if we assume that's about 80 basis points, and then we have to have a real yield that's going to be somewhere between 0 and 1%. That's sort of how you build up those numbers. Now, the more extreme we go, the more risk inflation becomes that can influence it. And there's one other factor I think that we have to think about and just make sure we keep in the back of our minds as well. We've talked about this before, and that is as the percentage of GDP that the interest expense on the deficit represents. The highest level we've ever hit was 3.2% back in the Bush 1 administration. And that's really what caused George H.W. Bush to break the pledge, no new taxes, was having to deal with that. That's a constraint that we could easily hit sometime next year in 2025. And it will be interesting how the market reacts to that. That's when you see those, then you get some crowding out. And if inflation isn't as benign as it's anticipated to be, then that could also constrain that as well. And that's why we sort of think about not just the bull bears, but also what those tails look like as well, too. Well, I want to thank all of you for coming together today. We'll continue to do these periodically through the year. I'm going to go back to what somebody told me when I first took a job where you had to forecast, they just said, do it frequently. And we keep that principle at heart all the time. So, and I hope everyone has a wonderful holiday season.